If you want to understand where the world is going, stop listening to what people say. Look at where multi-trillion-dollar balance sheets are placing their bets. For decades, the technology sector lived almost entirely in the digital world. Software, networks, cloud infrastructure. The assumption was simple. Technology would become increasingly virtual, increasingly scalable, increasingly detached from physical constraints. But something remarkable is happening. The companies that built the digital economy are being pulled back into the physical world. Today, technology executives are discussing power generation, touring industrial facilities, signing long-term energy agreements, and helping finance infrastructure projects that would have seemed completely outside their mandate just a few years ago. Why? Because the companies leading the AI race have discovered something the market hasn't fully priced yet. The cloud never escaped physics. In our last briefing, we mapped the bottleneck. We explored how the explosive growth of artificial intelligence is colliding with energy systems that were never designed for this level of demand. Many observers look at this friction and see a ceiling. They see grid constraints, transmission bottlenecks, interconnection delays, and they conclude that AI growth will eventually slow. But that assumes technology companies are willing to wait. They are not. The incentives are too powerful. When access to compute determines competitive advantage, and access to energy determines access to compute, electricity stops being a utility expense. It becomes a strategic asset. And when something becomes strategically important, corporate capital moves far faster than traditional planning processes ever could. In previous technology cycles, software companies consumed infrastructure. In this cycle, they are increasingly financing it. That distinction matters more than most people realize, because once software companies begin financing infrastructure, the boundary between the digital and physical economy starts to disappear. To overcome this bottleneck, the technology sector is pursuing two parallel strategies. One focused on reviving existing assets, the other focused on accelerating entirely new ones. Together, they represent one of the most significant shifts in industrial investment in decades. The first strategy is what we might call the resurrection play. Rather than waiting years for new capacity to emerge, technology companies are helping bring dormant infrastructure back to life. The most visible example is Microsoft. Rather than building new generation capacity from scratch, Microsoft signed a long-term agreement with Constellation Energy to restart a nuclear facility that had been offline for years. A reactor once considered economically unviable. Today, it is being prepared to return to service, backed not only by corporate capital, but by a federal loan from the US Department of Energy. The significance extends far beyond a single reactor. It demonstrates something structural. When energy becomes strategically important, private capital and public policy begin moving in the same direction. Projects once considered politically difficult suddenly become economically urgent. And economically urgent projects tend to attract capital, talent, and political support. The second strategy is what we might call the decentralized renaissance. Rather than depending exclusively on legacy infrastructure, technology companies are increasingly backing the development of an entirely new generation of energy technology. Small modular reactors, or SMRs, are compact, factory-built nuclear units designed to be deployed faster and more flexibly than traditional large-scale plants. Google, Amazon, and Meta are all pursuing variations of the same strategy. Secure the energy first, scale the intelligence second. Google has signed agreements to purchase power from SMR developers, targeting deployment before the end of this decade. Amazon has moved beyond simply buying power. It is now co-developing and co-financing SMR projects directly alongside reactor developers. Meta has issued proposals seeking gigawatts of new nuclear capacity to power its AI ambitions. And at a major global energy summit in 2025, Google, Amazon, and Meta signed a joint pledge to support tripling global nuclear capacity by 2050. These are not speculative positions. These are long-term capital commitments from some of the most sophisticated capital allocators in the world. Now, it is important to hold this picture with clear eyes. SMR technology still faces real challenges. Regulatory approval timelines are long, construction complexity is significant, and historical nuclear projects have rarely delivered on their original schedules. The efficiency of AI systems is also improving rapidly, which may reduce the rate of energy demand growth over time. But even accounting for those variables, the direction of travel is becoming difficult to ignore. The world's largest technology companies are no longer behaving purely as software businesses. They are increasingly acting as infrastructure investors, and in many cases, they are becoming the foundational customers that emerging energy technologies need in order to reach scale. This is the deeper story. The AI revolution is not only transforming software, it is reshaping where capital flows. It is redirecting investment toward the physical systems that make digital intelligence possible. The cloud is coming back down to earth, and the most powerful balance sheets in history are following it. This transformation is still in its early stages, but the trajectory is becoming increasingly clear. Next week, in the final chapter of this series, we zoom out to the global stage. How will the race for energy reshape geopolitics? Which nations are positioning to win the infrastructure race? And what does the dawn of energy abundance mean for the global economy and for you? This is the Pivot Compass. Subscribe. Position yourself where structural momentum is building, and start preparing for the physical layer of the AI economy.